Hey guys, welcome back to the continuation of the course, the Forex course. In this video, we're going to talk about the basic concepts and terminology of Forex. All right, so let's go ahead and start. So we're going to talk about currency pairs and quotes. Okay, so in Forex, currencies are traded in pairs, meaning you are buying one currency while selling another. So for example, you have Euro USD pair in which you're buying euros and selling US dollars. So let me just show it to you guys in practical just so you can see, because it's better for me to show it. Okay, so in here, as you can see, we are hold up no, yeah, we are using TradingView, which is a website in which we're going to be talking about later for us to see the market and whatever. So for example, let's go to USD. So I'm going to type in euro/USD. Okay. Let me put the Forex. Yeah. So you have the symbol and you go to Forex and then you have USD. So on the right side right here, you have the brokers. So you have Pepperstone, which is one broker. We have Owenda, you have ICE, Forex.com. So that for now it doesn't really matter. So let me just click on any one of them. And let me launch chart. So we're gonna launch the chart, and as you can see, basically when you buy a currency, you're selling the other one, and that's why the chart goes up, the market goes up or down. That's pretty much what happens here. So if you don't know anything about Forex, of course, if you're more advanced, you know about it. But if you've never traded before, if you don't know nothing about this world, then that's pretty much what happens. Okay. So here is the market. So this is literally the market, as you can see. And this is Euro USD. So for example, say you place a trade in this line right here. So as you can see right now, the market is around this level right here, which is 1.090085. If you buy your USD, you want the chart to go up, and you're going to be buying euro and you're going to be selling USD. That's pretty much what happens, or US dollars. Okay. Yeah. So let's go back there now. So for example, the base currency, the first currency in Euro USD, the euro is the base currency, and the quote currency, this is the second currency. So you have the base currency, which is euro, okay, and the quote currency is USD, because it's on the second part. So after the slash, so euro is the base, and then slash USD is the quote, and that's pretty much how it works. So you have your USD, you have your NZD. So it's like you're trading one currency of one country versus the currency of the other country. That's kind of how it works. Okay, so we have many currencies. For example, we have Euro USD, we have GBP USD, like I said, Euro USD, Euro GBP, AUD NZD, USD TRY. We have currencies from emergent markets as well, from emergent countries, most traded pairs, less traded pairs. We're going to be talking about it more in depth later, but that's kind of how it works. So for example, when you see a code like Euro USD equals 1.10, that means 1 euro is worth 1.10 US dollars. That's kind of how it works. Now we have the major pairs. All right, so let me just talk about it. These include the US dollar and the most traded, like the Euro USD, GBP USD, USD JPY, for example. They tend to have more liquidity and tighter spreads. So let's go back there just so we can see. So these are the most traded. These are the most traded currencies. Okay, so for example, let's go and see like GBP. GBP USD. Okay, this is British pound. So British pound against US dollar. So remember that GBP is the base currency, and then US dollar in this case right here is the quote currency. That's kind of how it works. Okay, so this is the GBP USD currency, right, in TradingView. We also have this thing called minors. Okay, they're minor pairs, which they don't include the US dollars. For example, these are Euro GBP and AUD NZD. So let me go ahead and type in AUD NZD. As you can see, this is AUD NZD. Okay, remember that AUD is the base currency and NZD is the quote currency. All right, so let me click here, and this is the market. This is the AUD NZD currency pair, and these are a part of the minors. Okay, because they are less traded than major. So for example, major pairs, they come from the highest, the most traded pairs, which could be like the major the major countries that move the economics of the world. So for example, US, because really strong, Europe, because really strong, British pound, really strong. These are more traded because they have more impact in the world per se. This is why there's this separation between major pairs and minor pairs. Okay, and lastly, we have the exotic pairs. So the exotic pairs, these involve a major currency and a currency from a developing economic, like the USD, TRY, US dollar, and Turkish lira. They have wider spreads and they can be more volatile. So for example, guys, I am Brazilian. All right, so yes, my exotic pairs would be like USD BRL. So if you don't know which currency we use in Brazil is real. Okay, so if you're going to be trading in my currency and you want to be trading somewhere in my currency, it would be something like this. So for example, USD BRL chart. This is an exotic pair. All right, so as you can see, the dollar goes up against my currency. So because I live in a third world country and it's a developing country, what happens is the strongest currency, which is US dollar, goes up against mine. Okay, so and for example, if I do BRL USD, so BRL being the base currency and USD being the quote currency, look at this. This is literally what happens with my currency in my country on the long term. So it only devaluates on the long term against the strong currency. And this is why you really need to understand about major, minors, and exotic pairs, because this is like the foundation of the strategy in which I'm going to be teaching you guys. Okay, so most of the times we're going to be trading on pairs that they don't act like this, like, which is not just going up infinitely or going down infinitely, like BRL USD, because it's in a developing country. For example, let's see Euro USD again. So Euro USD chart, there's a huge difference between like BRL USD, which is a developing country, versus Euro USD, which is both developed countries, like Euro from Europe and USD, because USA, as you can see, it's much more like, it's much less volatile and it's much more predictable, I would say, quote unquote, than BRL USD, for example, because it's not just going up or down. It's like there's an average price in the middle. So I don't know if you really understood what I'm trying to say, but it's faster and it's more safer. I mean, it's safer to trade in pairs in which you have a stronger economy than trading in pairs which you have a weaker economy, because it's too volatile. So the average of moving points in USD is way less than like the average of BRL USD. And like BRL USD, it's just one example, but it could be in exotic pairs. It's way more volatile than, for example, Euro USD. So Euro USD, it's safer for those reasons. And I'm really emphasizing that because this is like the introduction to the strategy. Literally, that's the introduction to the strategy. So let me just go back here again. Let me show something to you. So Euro USD, for example, Euro USD. As you can see, let me just put on all. So this is the interval. So since 1976 all the way up to now 2024, as you can see, like Euro USD, for example, there's like an average. There's like an average price, okay? Because like the market is never just gonna go up to the point where it's like infinitely going up, nor it's like infinitely going down. Okay, so it goes down to a certain point and it goes back up, and then when it's too stretched out upwards, it goes back down again, and when it's too stretched out downwards, it goes up again, and it's like a stretch band, right? And it always goes back to that break even point or to that average price point. And this is why it's much safer to be trading at these currencies than some currency that's like more like this, which is very unpredictable. Okay, I'm not saying that to shit over my country though. I'm just saying that because this is for educational purposes, because I need to let you know this, okay? Because I need to educate you. But that's kind of how it works. And this is just for your USD, but any major pairs, they kind of act the same way. Okay, so some a little more than others, but like the foundation is very similar. So this is why there is the difference, and you must know the difference between trading major pairs versus minor pairs versus exotic pairs. Because I'm not saying that you cannot trade in a exotic pairs or in a exotic pair, but at least you need to know the risk. So if you know the risk, you can literally be trading anywhere, any market. You can trade with at any market in the world. Doesn't really matter. But as long as you know the risk, because what happens is most people, they try to buy or sell, but they don't even know anything. They don't have no risk management. They don't know nothing about the market that they're trading at. They don't know about the risk, the volatility, the margin, the spread, the level. They don't know nothing. They don't know anything about the economics of the country or anything. They don't know nothing about nothing. And that's the danger of it. The lack of knowledge, the lack of experience can literally make you lose money. And again, I'm saying that because I want to make sure that you learn everything. Okay, I'm trying to be as thorough as possible. So that being said, I know that was a lot. That was a lot, but that pretty much sums up the currency pairs, and that's a very introduction. Very like brief introduction to currency pairs. So I hope you understood some of it. If not, then watch the video again, and if you have some questions, let me know down below and I'll be happy to answer you. And now let's talk about pips. So understanding pips. So a pip or PIP is a tiny measure of movement in a currency pair. So it's usually the fourth decimal place in a quote. So for example, if Euro USD moves from 1.1000 to 1.1001, that's a 1 pip change. So for pairs involving the Japanese yen like USD JPY, a pip is the second decimal place. So let me show it to you guys. The same concept, so you know exactly. So can you see those numbers right here? This 1.6, 000, 1.5, 000, 1.4, 1.3, 1.2, 1, 0.9, 0.8. These, like, this is where you're going to be measuring the movement of the market. So if the market moves up 1 PIP or 1 pip, that means the market moved 1 pip. Then if it moves down, it's the same thing. So let me zoom in. It's because you're not going to be able to see it now because the market's closed. But what I want you to understand, that every time the market moves like up like this, so the market always moves up or down, and then it forms the candle, right? The candle is formed when the market moves. So if the market moves up here and it goes back here again, but it finishes above the initial line, the market's up. It's a green candle because it's an upwards candle, right? It's a positive candle, and here is where you can see. But ideally is you can see if the market's moving. So for example, 1.9 to 68. If the market moves down to like 1.9, 1.09 to 67. I mean, sorry, it's a little, 58, yeah, it's 58. If it moves to 58, then that moved, there you have the measurement of the pip, so pip measurement. And I don't know why these things they're showing up to me. How do I even get rid of it? I don't even know. Sorry, guys. Let me reload this page. But that's kind of how it works, okay? So the market moved from pip to pip, okay? And here is where you're going to be able to see. So for example, you have 1.8728, you have 1.8734, 1.8746. Okay, and let me stretch it out even more. So the more we stretch it, the more we're going to be able to see. Okay, so here it is. Yeah, here it is. So 1.8016, 1.8017. So that's 1 pip literally. Okay, I'm stretching that even more to make it easier for you guys. So if the market goes up from 1.8016 to 1.8017, the market moved 1 pip, upwards. And if it goes from 1.8016 to 1.8015, the market went down 1 pip. Just so you know the difference. And as you can see, I can stretch that or shrink that so you know. And that's kind of what happens with the market. So when somebody says, oh, the market today is at 1.8020, or the market devaluated 1% or depreciated 1%, or there was an appreciation of like 1%, 2%, or the market moved 1 pip or whatever, you'll be able to know that this is what happened. Okay, more or less. Okay, I'm trying to be very, very, very fast, guys, so I'm not very theoretical here, but at least you must know at least the foundation of it. Okay, so I hope it wasn't too weird for you guys. I hope you really understood at least some of it. Now let's talk about lots and leverage. So lot and leverage. The lot is the size of your trade. Okay, so a standard lot size is 100,000 units of the base currency. But you can also trade mini lots, such as 10,000 units, and micro lots, such as 1,000 units. So, for example, if you have, let me explain leverage first, and then I'll explain that to you. So, like the leverage is, basically the leverage lets you control a large trade with a small amount of money. So for example, if you have 100-to-1 leverage, you can trade $100,000 with just $1,000. Okay, I don't know if you're with me, but that's kind of how it works. But be careful, okay? Because with the leverage, you can increase the profits, but you can also increase the losses. So the lot size and the leverage, they kind of go along. And then by the end of this course, you have figured out that actually not just these things, they go together, but every single thing that I talk about, they go together. Okay, the pip, the lot, the margin level, the leverage, whatever, everything, you need to make sure that you understand all these things together. And when you combine them together is when you increase your probabilities of becoming profitable on the long term. So basically, you can leverage your money when you do Forex. So for example, if you just have $1,000 and you want to trade in a $100,000 account, you're gonna be using the 100-to-1 leverage. So that means every pip that goes against you or in your favor, that would move in a $100,000 account with just with $1,000 account. Not sure if you really got it, but you're gonna get it on the once we start trading. Okay. So this could be, like I said, this could be either beneficial or bad, because if you don't control like how far you're gonna leverage your account, and how far is it worth leveraging your account. And if you leverage too much, trying to get profit too fast, that means you're gonna lose money faster. Okay, so you need to use leverage, because leverage allows you to trade more money with less money. But if you use leverage and you exaggerate, if you exaggerate too much, then you're just gonna use that against you. And that's what happens with most traders. And that's why you see most traders talking about making like 50% in 1 month, or 70% in 1 month, 100% in 1 month. And not that you cannot do this, though. You can do this, but there's even a deeper level to that conversation. There are types of accounts in which you would do such high interest monthly, and like there are levels to this conversation, in which I'm not going to talk about it now because it's too soon, but we're going to be talking about that throughout the course. Okay, so you need to understand this and how use leverage in your favor. Okay, so if you stretch too much, that means you're gonna blow up your account. But if you don't stretch it and you try to play it too safe, then that means you're gonna make a lesser percentage rate, than, like, for example, a treasury bond, and that takes away all of the reason to why you're doing forex in the first place. Because ideally, though, what we're trying to do here in forex is we're trying to get a higher percentage rate, because as we know, if you try to use treasury bonds and stock market and stuff like that, you get a lower percentage rate. I mean, not that you get a lower percentage rate, but like in forex, you can increase your probabilities of increasing your percentage rate in your money, rather than just putting in treasury bonds, for example. But of course, it comes with risk, so that's why you need to use leverage and lot to control it. Okay, so I know I talked a lot about it, man. I'm sorry, but I'm just trying to make you understand. But if you really didn't understand, just stick around, because we're going to be talking about lot sizing and leveraging many times throughout this course, and many times, like, for the rest of our lives as traders. So you're eventually going to get it down by training, just because you're going to be exposing yourself to it every single day. Okay, so yeah, that's pretty much it. Now we have, lastly, okay, bid, ask, and spread. So the bid price is the price at which the market or your broker will buy a currency from you. Okay, so it's the best price in which you can sell it. And the ask price is the price which the price at which the market will sell a currency to you. Okay, so it's the best price that you can buy at a given time, at a certain time. And there's also the spread. Okay, so the difference between the bid and ask. So this essentially is the broker's fee. So every broker has a different fee. All right, and beware. Let me just tell you right off the bat, beware of brokers that they offer you a spread-free commission, because if they're not charging for spread, they're probably charging for something else that could be worse than spread. Okay, maybe they are charging like higher swaps commissions. Maybe they are charging something else in which you don't even know. So literally every single broker has a different style. Okay, but make sure you trade in a broker in which at least you are paying spread, because whether you like it or not, you're going to pay spreads for brokers. And if you're not paying spread, then, like I said, you're probably paying for something else to make up for that loss that they are having. So make sure you understand about it, okay? So a smaller spread means lower trading cost, and like I said, aim for lower spreads in your trades. Okay, so every trade, depending at a given time, maybe there's some news coming up. So for example, if there's some news coming up and you want to trade at that time, the spread's gonna be higher, because that means that possibly the market's gonna be more volatile at a certain time. So you need to be careful with that. Okay, so the lower the spread that you pay, the better. Right, so there's also that. And lastly, we have the margin. So the margin is the money that you need. Okay, listen to me. The margin is the money that you need to open a leverage trade. So think of it as a deposit or a collateral. Okay, so, and that's kind of how it works. So for example, if you have $10,000 in your account and you're opening a trade, you need to see first the lot sizing of your trade. Okay, so for example, are you opening a trade at 0.01, or are you opening a trade at 0.09, or are you opening a trade at 1.09 or 5.09 or 10.0? So it really depends. Okay, and the higher that you open a trade, the lesser of margin you're gonna have. So this is why everything comes together. Okay, so the margin, the spread, and the swap of the operation, like all these things, they come together. And a lot of people, they don't understand about it, and because they don't understand about it and they don't have the margin available, required, that they need to keep the trade open, especially if they're doing swing trading, that's where they blow up their account. So I know it's a little confusing, okay? But like I said, just keep that in mind. Like if you're a beginner, just keep following the course, keep watching the videos. We're going to be talking about it every single day, and eventually going to get it down. Okay, and there's one other thing as well in which I like to say, which is called the margin call. So for example, if your account value falls too low because of losses, your broker might ask you to deposit more funds or close your positions. Yes, that literally happens. This is called a margin call. So for example, if you have a trade in which is, let me show it to you. It's easier if I show it to you. Let me show it to you. It's easier. So for example, let's go here. So I have this account here. For example, it's a $95,000 account. It's a prop firm, but still, just for the video, I'm gonna let you know. So as you can see here, the margin level is at 48,000%. But this is because it's a prop firm. But what I really have here though is 4,871%. So even though it's showing 48,000%, just ignore it. Just please ignore it, because this is a prop firm and this doesn't count like this. This is different, but that's the story. That's the story for another video, okay? And it just act like this is a 4,871% margin level. So for example, some brokers, they're gonna close your trades if you hit a margin level below 50%. So for example, if you have $10,000 in your account, and then let's say $90,000 and some of it is gone already, and what happens is, like, the more the trade is going against you, the more that trade is eating up margin of your account, and all the way down till you blow up your account. That's kind of how it works. So for example, if you open a trade and you have a 5,000% of margin level, which is this case right here, 4,000%, 871%. What happens is, if all the trades go against me, the more they go against me, the lower I have of margin. So for example, if I start with 5,000% and then the trade goes against me, I end up with 4,000%. And if it goes more against me, I go down to 3,000%. And then if it keeps going down, I go to 2,000%, 1,000%, all the way down to, like, I don't know, 100%. And if I hit, like, for example, 50% of margin level, some brokers, some of them, okay, and it depends on the broker as well, some of them are going to ask you to deposit more funds to continue trading, or they're simply going to close your trades without any proper warning, because it's for their own safety. So this is why you need to always take into consideration margin level. If you don't take into consideration margin level, which is like the first thing out of many things that you need to become successful at it, if you're really not paying attention on your margin level, and you let your account, like, go down to, like, I don't know, 1,000%, like anything below 1,000%, and that depends too, that's a deeper conversation than just simply being that generalist. But I'm just saying that just so you understand it. But, like, on average, okay, if your margin is below 1,000%, then you should be careful, because if there's some news coming up, or if the market goes against you, or the market stretches out against you for like a minute, because of some news or whatever, you could potentially lose money and blow up your account. And that's the last thing I want you go through, because I cannot stress enough how many times I lost money and how many accounts I blew up until I finally figured out what I figured out. And I don't want you going through the exact same thing. So please learn from it, even though it's a little annoying, because you're probably gonna save up years of your life. Okay, and also not just years of your life, but also money that you could have saved. Okay, because if I knew the things that I know today, I wouldn't have lost, like, maybe 3 years of my life depressed, because I put all my money into high risk investment, and I didn't know what I was doing, and I ended up fucking my life up. I'm just gonna say that off the bat. I don't even like cussing in the videos, but I'm just gonna cuss this time, because I've been through hell and back because of Forex and high risk investment, and that's one of the reasons why I'm here today, is because like I said, I don't want you going through the exact same thing. So please listen to me, all right? And if you don't want to learn from my words, then you're gonna learn the hard way, because the market is gonna teach you whether you like it or not. Okay. So please be careful. Please be careful. Okay. So yeah, that was margin. The continuation, I'm just gonna continue on another class, because this video is getting way too long already. what now, like 30 minutes long already, and it's kind of confusing. So I hope you like this video. Okay, thank you so much for watching. Please subscribe for more and stick around, because we're going to continue this class. And like I said, if there was any confusion, if you are a little bit if you didn't understand something, just ask the questions below and stick around, because by the end of this course, I'm sure you're gonna get these things easily. Because the truth is, guys, all this theoretical stuff here is good to understand, but once you really put your money you're not even gonna put your money anywhere, because we're gonna first train on the demo accounts, okay, on the simulator accounts or whatever. You're gonna train so much to the point that it's gonna be like second nature to you. So even though it might sound a little hard, it's just, you just need to give it time. Okay, give it time for your brain to understand, for you to familiarize with high risk investment. And I am really happy and excited to teach you this, because oh man, I love Forex so much now that I learned it, and I want to just give that knowledge ahead. Okay, so yeah, thank you so much, guys. Thank you so much. I'll see you in the next one. Bye. Let's go. Let's continue. Let's study hard.